Let me bring in Bismarck Rewane real quick here. Bismarck, let's get your take on what we're seeing play out here. Government Central Bank saying that inflation is more urgent, tackling inflation more urgent in its priorities here.
He's right, absolutely right. As a matter of fact, I'm quite impressed with the courage and candor to do what has to be done. I only wish we had done this earlier, but now, it's like they say, it's better late than never. So it's quite true that growth above a particular level, inflation above 12% is growth retarding according to the Central Bank of Nigeria. And therefore, this is the time to address this once and for all and take it on aggressively. So I would say it will achieve two things. One, it will moderate inflation to some extent. It will also help to strengthen the currency because the pass-through effect of a weakening exchange rate, together with the diesel cost, is now beginning to show itself as a hydra-headed problem. So, one, you have what you call high inflation, but it doesn't want you to get to galloping inflation. I'm not too sure whether it may not be too late, but like I say, it's better late than never.
Nnamdi, it's Fifi speaking here. Bismarck, I said that he is pleasantly surprised by the interest rate announcement. Your initial thoughts of the governor's speech are?
Yeah, thanks. So I'm not surprised with the increase in rates, but prior to the meeting, having conversation in-house, what we had said was, look, we've seen how all central banks, or a lot of central banks globally, we've seen the Bank of England, we've seen the Fed raise rates, we've seen Ghana, we've seen Egypt. So, so many countries all around the world, right, are focusing on how to rein in inflation. And I was just saying to my people that, look, I expect the central bank to start to look at that, especially as the last MPC meeting. We noticed that you had 4 of the MPC members vote to raise rates. And most interestingly, you had 2 deputy governors, which was a bit of a shift from the norm because they typically vote in line with the central bank governor's view. So, I'm not surprised. It's expected. We've seen real returns on investments, turn negative for a while. And if you also consider the fact that you've seen a lot of people moving from Naira to dollar investments, and we're going to the point where returns on dollar investments are much higher than you can get on Naira investments. It's almost becoming a no-brainer for a lot of people. So the best way to even start to help with the currency, which is also basically affecting inflation, right, from imported inflation perspective, is to start to increase rates and try and make holding Naira a bit more attractive than switching to dollars like everybody seems to be doing right now. Hello, Mr. Rewane. So, while we're waiting, this has been long coming. We've expected that this will happen for quite a while. And finally, the central bank has done it. What do you think would have changed their view beyond just the rising rates, inflationary pressure, which we've seen for a while? And also, how come they didn't consider the usual political factors around not wanting to raise rates in a pre-election year? What could have changed?
Look, I think it was quite clear. Nigeria didn't want to be an economic maverick, an outlier. So everybody, if the US has midterm elections in November this year, Nigeria has elections next year. And the US has raised rate twice already, and are going to raise it 6 more times, I think, before the end of the year. The same thing's happening in Ghana. They've gone to the peak. South Africa has done the same. There's no way that Nigeria was going to be an outlier, especially when you realize that this is global supply shock induced inflation, 1, domestic supply shock induced inflation, 2, 3, money supply saturation and high-powered money effect. And then you have the global spending. And of course, the currency has taken a beating. The Naira has taken a beating, and the parallel market is down to 610, 612 Naira for $1. Therefore, you need to use this to bring some kind of general equilibrium rather than partial equilibrium to the system. So here we are seeing economists speaking and not transaction bankers and not politicians speaking. So the days of politics, like they say, all good economics may not make good politics, but bad politics definitely will make bad economics. Therefore, there's no choice, because if you don't do anything, the central bank, the monetary policy authorities have no choice but to do the right thing and to do it now. Misdiagnosis, inadequate dose of the therapy has been the reason why the economy has gone down what we call the economic decay curve. The wheels are essentially off. So it's time to put the wheels back on. And I think this is a first step in that direction.
Yeah, I mean, I totally agree with you. And if you look at what they've done in the past, which basically has been to tighten using CRR, the fact still remains that the holders of the funds, the owners of the funds still have access to it. So despite the central bank tightening and taking away general market liquidity, people who still own those funds are still investing them as they wish. And so you see them, I mean, you have inflation at 16% plus, and you have 1-year treasury bills in the region of about 4-5%. I mean, almost makes no sense. So you have a negative real return of about 13%. And you see people still plowing money into FX, Euro bonds right now. Even the Nigerian Euro bonds are trading at about 12-13%. Which is basically about the same place local Euro bonds are trading. So I guess looking at all of that, that should have somehow also have impacted their decision. It'll be interesting to see how the local markets respond tomorrow. In fact, today, because market is still open, considering the fact that we had an early MPC today, and also expect it to have some impact on the equities markets, because naturally it starts to make fixed income more attractive. So I expect to see some pullback on the equity market, see rise in yields across bonds, across treasury bills. The only question will be how manufacturers will respond to this, because naturally it's increasing their cost of borrowing.
Well, let me come in here. You see?
All right, Bismarck, I'd like you to take you up on this as well, because when you look at what the central bank also said, it talked about is signaling more or less how they're shifting from their historic policy stance, and more or less what do you see in terms of an outlook for monetary policy going forward for Nigeria?
That's why let me break it down. One is the fact that the nominal rate, which is the policy rate, has increased by 150 basis points, signaling the fact that we are in a tightening environment. Two, what will happen to the general structure of interest rates in the economy? That is going to move significantly higher. What is going to happen to the exchange rate is that the exchange rate is going to appreciate, right? Because the first signal is tightening. The second signal is that you will see, and I expect that we will see a slight depreciation towards unification of exchange rates. So all of a sudden, we have gone back to what we call orthodox monetary policy. In the past, even if you took the CRR out, the amount of money you put back through intervention kind of neutralized the effect of the withdrawals. So on an aggregate basis, there was excess liquidity in the system. Average liquidity ratios were as much as 40% in a 30% rules environment. Therefore, this time, we are going to be seeing two things happen simultaneously. One, the increase in rates. Two, the tightening of liquidity. And three, a slight appreciation in the parallel market and a depreciation in the official market. That's what I expect to happen starting from today.
Nnamdi, I have a similar question for you, but perhaps just put differently. I mean, just given the fact that it was a unanimous decision to increase interest rates, what was not unanimous was the quantum of the increase, split between 150 basis points, 150. So as you look to the outlook, what is your expectation of the kind of interest rate increases Nigeria's central bank governor will likely filter through? I mean, are we looking at more 150 basis points? Are we looking at possibly 150? Just what's your sense based on the speech that was delivered a little earlier today?
I think that after this, we might see him pause at the next meeting and want to see what the effect of this rate hike has been, unless we see inflation continue to spiral before the next meeting. So if inflation stays about where it is, then I expect them to wait and see what the effect of this current rate hike will be. We typically know that it takes maybe about 2 months or thereabouts, or 3 months for you to feel the effect of a rate hike. So I'm not sure they will be in such a hurry to start to raise rates aggressively, unless between now and the next MPC meeting, we see that inflation has really shot up to maybe about like 18-19% levels. Then they might need to act again. But even if they do, I don't expect more than a 50 to 100 basis points hike.
I was just going to say, more or less, following up on what Fifi said, talking about what the central bank governor made mention of the supply side factors that are adding to inflationary pressures for Nigeria. How do you see this playing out? Do you think it could abate before the next meeting, or how do you see things panning out?
I don't see anything changing with regards to the supply side pressure. The war in Ukraine obviously has shown us that it's not going to be a short one. Everybody had expected at the beginning that it was going to be a short war, but we've seen Ukraine a lot more resistant. So I expect that to continue to play on whatever effect it has. If we look at wheat and coal, things that come out of Ukraine, we read stories today about how they've had ships locked in, they've had ports locked in, and they've not been able to, as an example, get their exports out of the country. We've seen the European Union talk about possibly banning Russian oil. And if that happens, you're going to see more pressure on energy prices. So I think that it's going to continue to play out for a while. I don't expect to see any resolution around supply side things over the next 2 to 3 months. I think the pressure is going to continue. And even if we look at it locally, I think we're going to face the same things basically.
And what do you think about growth? I mean, ultimately, the conversation right now is the central banks are increasing interest rates. There's concerns around the pace and the aggression of those interest rates and the implication that it may have on growth. Nigeria expecting growth of around 3.1% or so for this year. What do you think the interest rate environment, a higher interest rate environment, will do potentially to the country's growth prospects?
It's interesting that despite the fact that we had a 3.1% growth, we have seen a slowdown in growth quarter on quarter. So if you look at what we were in 2021 Q4 versus now, we've seen a slowdown. It's also, a bit frustrating for us as a country that we continue to see negative, growth when it comes to crude oil or petroleum sector, energy sector. So we need to see our output with regards to crude oil, start to rise aggressively if we expect to see growth changes, positive growth or larger or higher growth with regards to GDP. So I think we'll continue to struggle with that regards. Naturally, this will not help us in the short term, raising rates, but I think they're basically at loggerheads where you have to decide, look, what do we want to focus on? Growth or look at inflation? And I think we might end up getting to a point of stagflation if we're not careful, because they're going to have inflation continue to rise. And at the same time, you're going to have growth start to slow down unless, something happens. And like I said, I expect the war to continue. I expect supply side pressure to continue. So if you factor all of that in, then definitely I don't expect to see us see growth start to move up aggressively. I think we'll stay at current levels where we are, or we might even start to see a slowdown quarter on quarter by the time we have our net GDP growth results out.
Can I come in here? As far as growth is concerned, we think that second quarter growth is going to be lower than first quarter growth. Why? Because the price of diesel is up. The road transportation is down 25% quarter on quarter. Air transportation has been affected because of higher price of aviation fuel. And the rail transportation, which grew earlier, has now come to a halt. So you have a Greek slowing down, petroleum contracting, and then you have transport also contracting. Manufacturing will depend on how much foreign exchange is released. If foreign exchange stabilizes, you will not see the effect of that until Q3, Q4. Therefore, the time lag, which Nnamdi was talking about, may be too ambitious. You are going to see the spillover effect of international development and domestic liquidity affect inflation in May and June. And I will not be surprised if you see inflation as high as 19 or 19.5% in that period. And therefore, there will be a need again to probably hike up rates at the next quarter without threatening the economy into a recession.
But Bismarck, when you look holistically at the policy environment, yes, we've seen this response from the monetary side. I'm trying to understand what kind of supporting measures you could expect from the fiscal side of things to help show up the outcomes they're trying to achieve.
Well, with all due respectfully, I think all the fiscal authorities are distracted right now with political interests. And as you know, there are so many things happening at the same time. A moving target is 16 times more difficult to get than a stationary target. So all I can say is that do not expect any fiscal stimulus at this time. Everybody is concentrating on politics. So the monetary policy authorities are going to have to be able to rein in inflation, while the growth itself coming from fiscal stimulus will be constrained. So the only thing we have to do is to think and hope that oil prices stay high, and that the foreign exchange regime will allow for more disbursements and availability of foreign exchange, so manufacturers can begin to bring in as much products as they can. But this is going to be a very difficult year for Nigeria as far as this is concerned right now.
Nnamdi, you mentioned the potential reaction from the equity markets as a result of this interest rate hike. And I'm just wondering therein, where do you see opportunity in this environment? Where would you be putting your money if we do operate or think under the scenario of this being the start of further interest rate increases to come?
Well, typically, the beneficiaries globally of interest rate hikes tend to be the banks, because the banks do better when interest rates are high. It gives them high opportunities, one, to raise their asset rates, to raise the rates of loans, and also government securities rates most probably will start to move up, which naturally would give banks opportunity to invest at much higher levels than they were now. So, for instance, the T-bill rates we've seen trading sub 5%. I expect that with this hike and possibly more hikes to come in future, we most likely start to see those rates move up, which naturally would give banks better investment outlets. The same thing with bonds, because we all know that banks put a big percentage or a huge percentage of their funds into government securities. And then, like I said earlier, the same thing with their loans. They'll most likely start repricing loans. And when that happens, then that means that you will start to see higher net interest margins for them, which naturally would lead to better results across. It's not a coincidence that we've seen the bank results basically stagnate or struggle with regards to growth in their results over the last year or so. At the same time that we've seen government security rates pretty low, and also seeing MPR held steady. So I expect the banks to be the ones major beneficiaries if I look at the equities market, and those will be the first people that I would show some interest in.
All right, but Bismarck, looking at what has played out so far in terms of how the economy is, you mentioned that we shouldn't expect too much in terms of the fiscal side. But judging the Nigerian economy right now as it is, where it stands with the global pressures we're seeing and the shocks we're seeing play out, what is your biggest concern?
My biggest concern is that that we would leave the exchange rate completely misaligned. My biggest fear is that the price of oil could come down from 114 down to maybe 90 or $90 should be good at any point in time. But at this point, the Nigerian economy is much more dependent on oil and gas revenue and is not taking advantage of that situation. Therefore, the external imbalances will increase, the fiscal deficit will increase, the debt service level, because of the adjustment in interest rates, both internationally and domestically, would also increase. Whilst at the same time, productivity in the economy will remain flat. Therefore, we will struggle for some time. However, the opportunity here, when you come to the equity market, is those companies and in those industries where they had hedged their position well before by bringing in assets when the exchange rates were 300, 400, are now going to be able to price their services and commodities at the new exchange rate level, and therefore make some windfall margins while keeping costs, rationalizing costs. So you're going to see the telcos benefit seriously from the PSB status and from financial inclusion, from the 5G thing. Then you will see some manufacturers who have actually built capacity 3-4 years ago in the brewery space, in the cement space, and others, really take advantage of this. My biggest fear in the end, if that is to answer the question, is that there may be a need to look at wages again, because everywhere in the world, real wages have actually depreciated, and inflation is a thief of the wallet. Therefore, what can Nigeria do to adjust its wage structure to make it competitive and not actually fuel hyperinflation? So this is a classical example of what you call the trilemma, the monetary policy trilemma. That's where we are.
Sure. Nnamdi, your biggest concern, and we haven't quite spoken about consumer stocks and the FMCG side of the equity market, and we do know that generally consumers find it tougher to live when interest rates go higher and amid the constrained economic environment. Just your biggest concerns and your take on the investment opportunity potentially in consumer-facing stocks that could be hard hit by this rate hike.
So biggest concern for me would be around cost of debt in Nigeria. So we know that Nigeria spends about 70% of their revenue on debt servicing. So as rates go up, naturally we'll start to see higher cost of borrowing, higher cost of debt servicing for the government. And the question would now be, how much are we going to spend from our revenue on debt servicing? So it'll be interesting to see how that plays out. Opportunities, like I said earlier on, would be investing in stock of the banks, which I think would be good. I also hope that with this, we'll start to see a bit more faith in the Naira. And like Mr. Rewane said, if we start to see or if we can see some tweaking of the FX rates, exchange rates, and start, get a more market-based type, exchange rate policy, then we might start to see a bit of inflows coming into the country. So, because currently where we are, we have almost very little, almost zero investments currently coming in, fresh investments by portfolio investors into the fixed income markets. It will be interesting to see if, rates start to go up, we're going to see them coming in. And if that happens, at what level they'll look at. So that creates an opportunity when those rates do go up for people. But I would like to see how this affects fiscal side with regards to ability to borrow. The Eurobonds rates right now are very high. We've seen Eurobond yields go as high as 12, 13%, which means it's difficult for them to go to the Eurobonds market to borrow. So they're left with the local market, and then local side rates starts to go up. So it's definitely going to impact cost of borrowing for the government as a whole.